Hey everyone, I'm trying to get rid of this one. She's got to go ahead and get in the shower. But up next, we're going to talk about why you shouldn't buy a home with the FHA loan. Efrain Reyes here, Real Expert Consulting, and yes, you heard me right. If it's an FHA loan that you're buying with, stay away from it by all means if this is you. Let's break down what an FHA is and isn't. First and foremost, what it isn't is a first-time home buyer's grant or loan. Anybody can acquire this or acquire a home with an FHA loan. And again, depending on length of time of ownership, etc. The main criteria for an FHA loan is usually having a credit score above 580, right? And some banks, certain states can do it even as low as 540 actually. So that's all dependent on the area or the banking you're working with. Also, with the FHA loan, it's a federally insured loan. And since it's federally insured, they're allowing you with the adverse credit, whether or not you have it, but to put down as little as 3.5% down of the total purchase price of a home. And again, it's all variable to your income, so many different things, but it's quite easy to get. However, it's a very scary situation if you're not prepared financially. And it's not more so the upfront cost, but the ongoing. And the ongoing, when you do take out a FHA mortgage, you're really committing to something that is going to cost you a little bit more. It's a premium for putting up less, if that makes sense. I can see the propensity to go ahead and be tempted by the concept of putting 3.5% down to own a piece of the American dream. But please be advised that it does come at a higher cost. If you're coming up with 3.5% down, there's something called MIP that's attached to the loan. And that's attached to the mortgage and also the interest that you're paying on it. The mortgage, I mean principal and interest. And aside from that, the MIP, which is a mortgage insurance premium, it can be anywhere from 0.70 to 0.85% on a 15 or 30-year loan. And that's additional to everything you're paying, taxes, utilities, etc. Something to think about. Often, many of those that are not doing their due diligence often pay PMI. And PMI is something called private mortgage insurance and is also sometimes stacked on top and rolled into the payments of everything I just mentioned. So buyer beware and do shop around. Usually a PMI is attached or recommended by a lender if you have a buyer that is more credit risk, more of a credit risk or a financial risk. And similar to car buying, usually if you have the more adverse situation, you're going to pay the most rather than the tier 1 or the tier A type of buyer. I don't know what it's called in the car industry, but you get my drift. And so if you're not ready to go ahead, whether it's work-wise or you're not forthright in thinking that, okay, you know what, my situation may call for me to buy a home with an FHA, even if it's going to cost me money, then if that's not you, please stay away from it. And in different parts of the country, obviously a FHA can be more beneficial, but prime places like New York City, San Francisco, LA, certain places in Miami, the costs are out of this world for a single family home, for a starter home. It may be more beneficial for you to go ahead and save anywhere from 10 to 20% down to apply on a mortgage. Some banks, some lenders even offer, depending on your credit situation, debt to income, even as low as 5% with no PMI. Yes, it happens. There are all options. And that's the beauty of real estate and finance, is that there are options that aren't just one way. And for full transparency, I want to go ahead and say that FHAs aren't for those buyers out there that are looking to own on a discount. It's not that kind of situation. As the barrier of entry is so low, expect to pay a premium on that entry point. But don't be so disheartened by this news or information, because you could always refinance in the end. And again, that's a different conversation to have, and you could have that with your lenders at any time and discuss what the possibilities might be. My position here is to get you thinking and asking questions, and please do consult with your lender and just figure out what's best for you. And although it may seem that FHAs are far-fetched to acquire single families starting off here in markets like New York City specifically and or San Francisco, because it's such a huge expense, there are alternatives. And here's the caveat. Caveat is simple. Owning multifamilies in places like New York City or San Francisco, where the incomes are higher, so are the rent rolls, etc., and the home prices. Owning multifamily home becomes and puts you in a position of being a landlord and can definitely offset costs tremendously, where, rents are good. So it can possibly with the right property and the right representation, you're able to acquire a property where your rental costs, right, as an owner, are cheaper than the market rents. And you are the landlord collecting all the benefits from the tax benefits, from depreciation, appreciation, equity, so many different facets of the home owning experience that you're becoming a beneficiary of with only 3.5% down. How does that sound? Now, you may disagree or agree with everything or some things that I'm saying, and I love to hear your feedback. Please like, comment, dislike. I welcome it all. In times like this, especially with the sheltering in place, most of all, be well.